Hey everyone, it's Abaroa for Financial Intelligence Training. It's Friday, it's June 8th, it's 2018. I'd like to start today's post with a special congratulations to the Washington Capitals on their first Stanley Cup victory. 43 seasons, no cup. That drought is over. Now, I joked on Twitter that had it been the Vegas Knights that won, by the way, they got a great name, it would have been their first with one season into the making. Now, tomorrow, we're going to have the elusive Triple Crown, which will be sought by Justify in the 150th running of the Belmont. Stay tuned there because twice this week, we could have history in the making. Now, the G7 is getting underway this weekend. Let the needless banter begin. Trade war, no trade war, and then, of course, next week, the summit. June 12th is the day. So we're going to have a lot to talk about in next week's post, I suspect. Now, let's talk markets. On the post Wednesday, I mentioned the firming up of the markets, and technically, they look improved. Now, I did retweet a rather interesting read this morning on credit risk. Investment-grade credit has been underperforming equities. And the theme of the article, it's based on the interpretation of a well-known bank, and it is suggestive that on a rolling basis, when credit risk underperforms their underlying equities, we tend to see forward weakening in that risk exposure. Of course, should we flip the variables, well, the opposite assumptions hold true, right? Well, in my humble opinion, the recent setups that we've seen in the market counter that argument and, well, may very well be the reason we often hear the phrase, past performance is not necessarily indicative of future results. Well, let's hope that's the case, as the leaks in the dam that I've been talking about, well, they've started the repair process. Yet, we've got a very fragile undertone that remains. So what do I define as a fragile undertone? Volume has not walked hand in hand with the improving chart patterns. In a recent post, I noted that roughly 45% of charts look fair or good compared to 20 or 30% that I pegged about a month ago. That's a notable improvement. Well, the fragile undertone in those improvements is on a weak foundation of volume, or better said, lack thereof. Now, that doesn't mean that's bad. It just means it's fragile. So I'd love to see some volume jumps there. Now, if you look at the betas that we've been discussing, you'll see some of the slips that are already occurring, and I think it's largely suspect because of volume, absent volume, and perhaps some rotation. And if you look at some of the bigs yesterday, you'll see that what I mean specifically there. Now, switching gears on my last post, I spoke to the financials and alluded that a new leak had sprung there. Again, financial intelligence training students understand why the following statement is extremely important. The reversal that we saw Wednesday in the banks is exactly what we wanted to see. Do yourself a favor and look at the chart of XLF. I would swear that someone bought a giant roll of flex tape off of one of those annoying TV ads and fixed that leak. Dive deeper into the complex now and look at the components. But first, recall my post from May 22nd when I was in downtown Orlando. I spoke about JPM and leadership. And leadership is something that we discuss a lot in the financial intelligence training class. So look at JPM. Look at the drop that ensued there, and not just there, but across the sector. And then note the bounce off of the 200-day moving average on May 29th, specifically on JP Morgan. Now look at Morgan Stanley, also discussed in that post, and see how it's been swimming below that 200-day level since. Look at Goldman, look at Citi, you'll see the same exact occurrence. Now, they're all still down since the 22nd, but JP Morgan fell the least. I think it was under 2%, and currently it's dancing along its 50-day moving average, a very different story to the complex. Now, when I look for leadership, I look to see how they perform under pressure, as we just looked, and would expect those to lead the charge higher, meaning JPM. If the sector can get some traction here, it would be my best guess that JPM would be one of those top gainers. Time will tell, and guys, that's not a stock recommendation. As we head into the final 4 hours of this week's trading, I'd like to see a lift here to make up for some of the pressure that we saw yesterday. So let's see what happens as we go to the close. If you are trading these moves, remember guys, stock and stock options involve a substantial degree of risk. It's not suitable for all investors. I'm Abaroa. This is for Financial Intelligence Training. Have a great weekend, everyone. Go Justify. Thanks for watching.